This is Tom Rowlands-Rees, and you're listening to Switched On, the podcast brought to you by Bloomberg Bnef. Sustainable finance has entered what you might call its messy middle. After years of rapid policy expansion, 2025 saw 20 major sustainable finance developments globally, but 4 of them were rollbacks. The EU weakened flagship corporate reporting rules, the US withdrew its last major federal ESG guidance, and other markets signaled pauses or simplifications, even as Asia-Pacific continued to push forward with new standards and taxonomies. So are we witnessing a retreat, or simply the growing pains of a framework that has become significant enough to face real political and financial pushback? And as reporting standards consolidate and investors continue to demand better data, what does this next phase mean for the future of sustainable finance? On today's show, I'm joined by Maia Mesanger, a Bnef specialist in finance policy and transition risk, and together we review findings from her note, Sustainable Finance Policy Quarterly, 4Q 2025. Bnef clients can find this note, along with other sustainable finance and policy research, by heading to Bnef Go on the Bloomberg terminal or bnef.com. If you'd like to learn more about how Bnef approaches strategy research on the energy transition, including developments in commodity markets, trends across different sectors, and the cross-cutting technologies shaping the future, you can find more information on bnef.com. And if you'd like to speak with a member of our team about becoming a client, email us at sales.bnef@bloomberg.net. But for now, let's dig into how sustainable finance is evolving from here. Maia, welcome to the podcast.
Hi, Tom. Really happy to be here.
So we are talking about sustainable finance today and sustainable finance policy. I suppose sustainable finance is one of these things that sounds very simple. We know what sustainability is, we know what finance is, so surely we know what sustainable finance is. But it's a bit more complicated than that. And I'm assuming that there's a range of expertise amongst our listeners. There's probably some of the sustainable finance OGs who are listening as much as anything to hear whether you give them a shout out or not. Maybe some people who are less familiar with the subject who, know, like I say, what the word sustainable means, what the word finance means. So Maia, before we kind of dive a little bit deeper into some of your latest research into sustainable finance, can we just clarify for everyone, and maybe to some extent me, what we really mean by sustainable finance?
Yeah, sure. It's almost we could do a podcast just on this, because this has been questioned quite a lot recently.
All right, let's do it.
Yeah. I'd say it's basically there are two sides of it. It's the integration of sustainability matters related to environmental sustainability matters, social and governance matters, integrated within the decision-making processes of financial institutions, which also means that companies have to take it into account, report on environmental, social, and governance matters and their performance so that action can be made by financial institutions off the back of it.
So what does that look like? Does that mean that there are certain definitions created around finance that kind of rate its sustainability along those different metrics, and then companies have targets or expected to report on them?
It's a great question. So to have sustainable finance, you need to have sustainability reporting. That's also why policy is so important. And effectively, for the longest time, we had a lot of voluntary framework that promoted reporting from companies on these particular topics. And then progressively that came into law, and the goal was to have standardized data so that we could rate companies off the back of their sustainability performance. And so that financial institutions could effectively take this into account and start ranking, analyzing companies off the back of it. Once you get that data, I would say that the second step was to define sustainable finance. So created frameworks around what we call green, what we call sustainable, what then we could consider to be a green bond, which is like a green piece of debt that is publicly traded or somewhat publicly traded, or a green loan. So it was about creating all of these classifications, which are often referred to as like taxonomies of what we call green, or sometimes sustainable, or sometimes social, depending on the market. All of this got really important, and that's also why we also started having like what we call financial instruments standards. So once you know what is green, you can then define what is a green fund, What is a green index? What is a green piece of debt? And it's true for social and the governance aspect, but also sustainability, which is a broader term to basically encompass every aspect of the environmental, social, and governance impact and performance of a company or of an institution. There are these kind of like frameworks, and policies played a big role in defining them, even though for a long time we would still consider it to be policy if it's voluntary.
Well, I've kind of got a question like that because, you know, in a way, there's a sort of an arc of where this started and where it should ideally go. And so let me just test whether this makes sense to you. I mean, I always remember maybe not everyone's seen this film, but there's a film that there's a scene often referenced in the film The Life of Brian by Monty Python, where there's all these different factions. There's the People's Front of Judea, there's the Judean People's Front, there's the Popular Front of Judea. And they all basically have the same objectives, but they're all actually kind of competing with each other and getting in their way. When you described the world where this was voluntary and there was like multiple frameworks, you know, could you characterize that as being a little bit like all of these different factions like the People's Front of Judea? And then the ideal of where they're getting to is where this is mainstream, i.e. just like the People's Front of Judea one day wanted to be the government and in charge, ideally there would be one framework and it's universally adopted. Yeah. And is it fair to say that we're somewhere in the middle of that arc in the journey, like in that transition?
I appreciate the analogy because I've never watched a movie from the Monty Python, and I'm about to have the British citizenship, hopefully. So,
well, you definitely have to watch it if you're going to get British citizenship.
And I think, indeed, everyone is like trying to strike the same goal. And when we say everyone, then in this particular case, we could say every market, every policymaker, every like jurisdiction is trying to attempt the same goal, which is like unlocking financing for the energy transition if we focus on the environmental and climate side of all of these. And when it comes to that, they've tried many different paths. And even within these paths, like whether it is by defining a green taxonomy or enforcing climate risk disclosure, they all went their way instead of building like a common framework. And that was in the first few years, which I would say we're talking now 10, 15 years ago, the inception. And then like there was a ramp up about like 6-7 years ago. Then really important and well-known central bankers got in like really vocal about it. Mark Carney with his speech, A Tragedy of the Horizon. Christine Lagarde followed. And then it became really popular. And then every market wanted to have its sustainable finance roadmap, like policy roadmap, its own sustainable finance policy regime. And for instance, they all required different sorts of reporting from companies and financial institutions. What was considered green in one market was not necessarily green in another market. One of the big examples of that is gas. It's one of the most controversial one. But you do find it in cement as well. You do find it in waste management. You do find it in the management of water. So some markets imposed themselves a bit more and set a standard. That was the case for the EU. And I hope we're going to talk about why the current rollback sourcing in the EU effectively has an effect globally, because everyone was imitating them up until now. The EU was one because it was one of the most ambitious one, but also then there have been initiatives to try to basically coincide everything into a global framework. And for instance, for climate disclosure and sustainability disclosure more broadly, one initiative in particular called the International Sustainability Standards Board, which comes from the IFRS Foundation. So for anyone who's listening to us that comes more with like an accounting background or a finance background, or is just like working in a company, they'll have heard about that because it's a set of international accounting standards that everyone was following. They went and they were like, okay, we're going to try to build the same way we've built an international standards for accounting, which did not exist before. We'll try to do the same when it comes to non-financial reporting. So all these sustainability matters. And that's how they've built the ISSB framework. It was really important and really difficult because you have different markets with different philosophies and visions of sustainability and the energy transition that had to agree on what companies have to report, but it got quite popular. At this stage, 18 markets have reporting in alignment with that framework in force, and another 16 are working on it. So it means that if you're an international investor or a lender, you get access to standardized data from many different companies across the globe, and then you can compare them, even if you're talking about companies that are like small Indian company and a large Canadian company. And it also means for companies, they can report on one set of data and fit the request of many different investors wherever they are across the globe.
So there's been real progress made by the sound of it in those international standards. And, I'm only tangentially aware of the journey that the accounting business has gone on to get aligned internationally. But I know that was a very long and arduous progress. And so maybe there's cause to be glass half full that things have moved as quickly as they can, maybe, because, go back to our initial framing, it might seem like things move slowly, but it takes a lot to go from being this fringe set of revolutionary groups to kind of becoming a unified global standard. So I suppose then, we kind of talked a little about the history and the kind of the framing. So let's kind of bring it to the here and now, because we are here to talk about some of your more recent research. 2025 is over. We're now in February 2026. Yeah, what happened in 2025 in this space?
I'll first go for the positive, and then I'll get a bit grimmer. But I think there has been a lot of advancement when it comes to standardizing, when it comes to maybe calming down a bit the rhythm at which policymakers were publishing new rules and laws, because I think at some point it became a bit everything everywhere all at once. And therefore, it was really difficult to follow. And then it was sometimes seen as a compliance burden. It was sometimes certain policies that were contradicting one another. And so I think we entered in 2025 a moment of like, okay, let's take a step back, consolidate our view, see if what has been implemented is working, if it's actually delivering the output we wanted and the results we wanted, which is, when I'm talking solely about sustainable finance, and in particular climate risk and climate investment at the minute on the climate side, is like, has it delivered on unlocking new financing for the energy transition and also allowing the financial system to assess its exposure to climate risk?
Can I ask a quick question on this? Because, you painted a picture of, the pace has become a little bit less frenetic in terms of the announcements. And so there's maybe more time for consideration, for alignment, for assessing effectiveness. There's various different stakeholders here, the policymakers, the financiers. I suppose those two stand out as principal stakeholders. I mean, to what extent are these people, because we're talking in abstract terms, that policies were made by someone. To what extent are all of these different stakeholders actually talking to each other? Whether it's like one government comparing notes with another government, before they come out with their contradictory frameworks. Do you have a sense of where the conversation is happening? Like, who's talking to who here? Or if anyone's talking to anyone?
I think at the beginning they didn't talk that much, but then a lot of initiatives started. For instance, we saw a common ground taxonomy being put out like a couple of years ago by the EU and China, because China had its own taxonomy and the EU had its own taxonomy, and both represent like a big market with companies willing to report against it, or in the case of the EU, having to report against it. Okay, let's put ourselves together, create like working groups, and then they've developed this like paperwork that was basically saying, okay, what are the commonalities and the discrepancies between our two frameworks? We saw a lot of bilateral work like that. We saw it between the EU and South Africa as well. On the taxonomy world, a lot of taxonomies globally have also found a lot of inspiration from the EU one, so that played a big role. They've developed something called the International Platform on Sustainable Finance, which gathered many different jurisdictions from all across the globe. Some regional association played a big role. So for instance, in Asia Pacific, the ASEAN association was really, really important. Some policies are at ASEAN level, in particular their taxonomy. So that was a good one. And then COP play a big role. The G7 meetings. So a couple of years ago, we saw at G7 an announcement of passing reporting against the ISSB standards. And then the cherry on the cake of all that, the ISSB, which is an international platform, which is an international body that is not led by any country, but some countries are actively developing the ISSB standard, played a massive role. Even like the EU that has its own standard still was part of that initiative and was like really active in it because they wanted to make sure that even though they have a different standard, if you comply with the ISSB, you comply with their own standard, the European Sustainability Standard, called the ESRS, and vice versa.
It's interesting because, when I listen to your answer, like there's various conversations going on. I think a thing that stands out, and it kind of goes back to your previous point that you made earlier in the conversation about EU leadership, is like, there's a lot of bilateral conversations, but the examples you gave were the EU and someone. So a lot of people are talking to the EU, and then even the sort of the international standard that is not being led by anyone in particular. The EU is very active in kind of bringing what they're doing into alignment. So I guess, I asked, where is the conversation happening? And I suppose in all sorts of different places, but it seems like a very loud voice in the conversation and a voice that is both heard and also a body that is listening is the EU is like a very central to all of this globally. Is that a fair statement?
Yes, it is a fair statement. And it's, initially I thought I was a bit biased because I'm based here, because I'm based in London. And I was part of the EU platform on sustainable finance developing the taxonomy. So I thought I was biased, I think that the EU has a stronger voice than it is. And there are so many other initiatives elsewhere. But effectively, through my travels, through my interactions with clients and my research, I've realized that no, it's been the leading voice. Sometimes I have clients in Asia Pacific, I do conferences and I talk to them and they really want to know what's happening in the EU because they know it's going to have a trickle-down effect elsewhere. And they know that if something is being developed here, eventually down the line, it's going to happen elsewhere and it's going to be replicated elsewhere. And we've seen it quite a lot when it comes to creating these frameworks on how to define ESG funds, so funds that take into consideration these environmental, social, and governance criteria, greenwashing standards to prevent greenwashing, the taxonomy and all of that. And so that's also why at the minute, the fact that the EU is weakening its flagship policies.
This was going to be my question because it's in the notes. What have you done in 2025 since we've established that they're a leader in this space?
So the EU has been a leader in this space and I'm often asked why, who is the person behind? I used to have this question quite a lot, who is that person driving it? And I think
it's you, Maia, it's you.
Absolutely not. And that's exactly my answer is it can't be one person. I think there was an alignment of stars, of people with the same mindset and the conviction that first, finance has a role to play in society, which is to invest in alignment with the values of society. And that's the vision that's developed by Mark Carney and Christine Lagarde, for instance, and other financial thinkers. But also, and most importantly, climate risk represents both a risk, a threat to the financial system, and therefore we need financial institutions and corporations to realize that and consider it. But it also climate and the energy transition represents an opportunity, an investment opportunity for the current decade, which is very aligned with what we think at Bnef. And therefore, there needs to be stuff put in place to both hedge financial institutions and corporations from these risks and promote the investment in there. So they've developed a lot of stuff. Maybe too many things.
Well, so tell us about, this, I think you used the word watering down the EU has done.
So you need to understand they've developed too many things. And then at the end of 2024, there was a report that was put out by Mario Draghi, who is then the previous European central banker. And it was about how do we keep European Union's company competitiveness. And one of the big lever that he raised was to say the sustainability policy, the sustainable finance policy agenda in the EU is too heavy and too burdensome, and it needs to be weakened down. And that had been a call already that was raised in a wish that was raised by some other leaders leaders in the EU, including Emmanuel Macron and also the German Chancellor.
Can we just define what he meant by too much of a burden? I think when it comes to this sort of thing, there's two ways I could think something could be a burden. One is if you set the bar too high for something to qualify as sustainable, but it might be very simple to report on in terms of paperwork. And then there's the other version where it's just literally the amount of bureaucracy involved, irrespective of how ambitious the targets are. So when you say it's burdensome, which flavor of burdensome are we talking about here?
There is the first aspect of it's really difficult to be considered green, and therefore you can report on it, but no one is going to be green. That was the issue with the taxonomy. But in the particular case of that report, that was being criticized already.
Right.
But the second aspect was that we're requiring companies to report on far too many sustainability criteria and sustainability data points, and it costs them a lot of money. And these are too specific. Just to give you an idea, under the Corporate Sustainability Reporting Directive, which is one of the 3 flagship regulations that are being targeted by this particular request to ease them, under this Corporate Sustainability Reporting Directive, companies are being asked to report on 1,200 data points. Right. And they're not all voluntary, but they need to prove that they are not material to them to have the right to not report on them.
And is there a sort of a minimum size of company, or does this if we started a company together, would we have to report on these 1,000 data points?
So before the weakening, under the previous version of the law, which was passed, we were talking about 50,000 companies that were in scope for that reporting, including small and medium companies that are not publicly listed. So we were talking about large listed companies, which are really used to this, even though they were still saying it's too many data points.
But they can employ someone to do it. It's fine.
Yeah, exactly. They were hiring people, even though they were still hiring big amount of people to do it, because they had to do that analysis on their whole supply chain as well.
Right. Oh, wow. Okay.
And then after, you had also non-listed companies, any company that does business in the EU or is listed in the EU, even though they're not domiciled in the EU. So you can imagine how much lobbying they got against that. And then small and medium enterprises. So that was the previous version of the law. And that scope of company were also in scope for reporting under the EU Green Taxonomy, Sustainable Finance Taxonomy, that classification I was talking about at the very beginning. So reporting the percentage of their revenues, the money they make, and their capital expenditure, the money they spend, that is considered to be green. And then there was a third policy that was being tackled by this report, which is called the Corporate Sustainability Due Diligence Directive. And so whilst the taxonomy and the CSRD, that Corporate Sustainability Reporting Directive, were really focused on reporting, give us a state of play of how you're doing and everything, the CSDDD was focusing on show us and implement the right due diligence when it comes to environmental, social, and governance matters all across your supply chain, even for companies that are not EU domiciled but make business in the EU.
Right.
It was very ambitious, and last year, then there were at the beginning of last year in February, then the European Commission announced what we call an omnibus package. So it's a set of proposal to weaken these rules in scope, in terms of their scope, the number of companies that are in scope for it, in terms of their enforcement mechanism, so the kind of fines and penalties that companies and directors directly could encounter if they don't abide by these rules, and also in terms of what's inside the actual regulation. So reducing the number of data points you have to provide, reducing the stuff you have to follow under the rules. In February, that proposal was published, and it's not until the end of the year that the actual amendment to the policies were passed.
So let me just make sure I've understood. So it's mainly less companies in scope and a streamlined taxonomy to make it easier to report.
I would make two baskets. The taxonomy got weakened, more streamlined in terms of the tests, but it still remains quite ambitious when it comes to like proving that you're green. The scope was really slammed in this one. It got really weakened. However, on the CSRD and the CSDDD, and this is why they got a lot of attraction when it comes up like interest and why people were caring about it. The scope was reduced like dramatically. We're talking, I think for the CSRD, we went from 50,000 company to less than 10,000. Right now, we're awaiting the new standards. So the reduction in terms of like the reporting they have to do under this rule. And for the CSDDD, they've reduced the amount of companies that are in scope. And they've also reduced what companies have to do to comply with that regulation. And that really weakened the legislation.
Can I just ask a question? I know we've really kind of dwelled on this a lot, and we are going to talk about, I think it's because we've established that the EU is a leader in this space. So it kind of matters if the EU's watering down. I just really want to understand this watering down. Do you have a sense? We're going from 50,000 companies in scope to 10,000.
Yeah.
I'm assuming that the 10,000 that remain are bigger companies, bigger emitters. Do you have any kind of handle on, in terms of, say, emissions that are in scope before and after? I'm assuming it's not a factor of 5 reduction like it is with the number of companies. Do you have a sense of that?
I don't have a sense of that, but I know that there are research done about this. The thing is that the CSRD was not just on emissions. It was on circularity. It was on biodiversity. It was tackling human rights. It was tackling governance.
Yeah, maybe I'm using the wrong frame when I say emissions. I just mean scale, whether it's on a number of employees or revenue. Because sometimes these things, the narrative can be like, oh, this is disastrous. It's like gone from 50,000 to 10,000. But actually, in terms of actual whatever it is we care about, it's not a big difference. And if that's going to be the difference that makes the policy work, then maybe it's a worthwhile sacrifice. That's just really the question I'm asking.
Yeah, I think it's a really interesting question to ask, because I think that the market has asked itself this question a lot this year, because I think we could see it from that angle, but I think what the whole market agreed on is, yeah, it was over complex. It had to be simplified, but they could have simplified the content of the reporting rather than simplifying the scope. Because if you think at scale, to prevent a financial crisis related to climate risk, to enable financial institutions to assess their exposure to climate risk and assess their capacity to invest in the transition, they will also need standardized data from small companies, medium companies, non-listed companies, and slamming the scope, even if in terms of GDP or in terms of, I would say, number of employees, it's less than the total scope. It's not proportional. Agreed.
Right. When you frame it like that, it seems that, almost like maybe an overreaction to it being overburdensome is that, there's different levers you can pull. There's the scope and the content. Try changing the content first and see if that makes things work.
But I want to say something Tom, that is really important, is why this got passed so easily in itself, why the European Parliament passed it and stuff. First of all, there are two things. They were facing a lot of international lobbying against these legislations because the EU was taking a lot of liberty to basically regulate non-EU companies. And so, for instance, that other sustainable finance policy that I was talking about, the CSDDD, the due diligence directive, was actually the second most lobbied rule in the EU over the past 20 years, according to Politico. Which is wild when you think about it. We're talking about a due diligence directive. We're talking about a sustainability directive, really important, showcased. And there have been really strong voices. In particular, the US has openly lobbied against that policy. And they've asked the EU at multiple times to drop non-EU companies from it and to weaken it. That happened. And we had a political shift in the EU. The reason why these amendments were passed is because the right-wing parties made a coalition with the far right at the European Parliament in an historical way to pass these amendments, because these political parties deemed the CSRD and CSDDD to basically be too costly for company when it comes to reporting.
Interesting. I kind of think back to the Monty Python analogy. It's that, it's almost like all of these different factions discover that as soon as they become an actual effective political force, they face new challenges, which is they become a threat to other interests and suffer real pushback, compared to when they're just on the fringes fighting among themselves.
Yeah.
Now, what are we seeing happening around the world? If you can quickly summarize some of the key highlights, in particular that may also be reflecting what's, the sort of the knock-on effects of some of the changes we've seen in the EU.
So we've seen other markets rolling back their sustainable finance policy agenda, some of it, or delaying them or postponing them. In particular, for instance, Switzerland, South Korea, Canada, they've really said that they're either, some of them are opposing altogether the development of some of their rules. It's the case in these three markets. And they directly claim that they are trying to wait and see the unfolding of the events in the EU and in the US, which is my next point. We've seen New Zealand also passing, due to also a political shift in the government, passing a rollback where it weakens the scope and the enforcement mechanism of its climate risk disclosure. And in the US, since the election of President Donald Trump, the US has repealed all of its sustainable finance policy at federal level. And it's at the state level, half of the US state have passed at least one anti-ESG, anti-sustainability rule that prevents financial institutions to take into account these matters if they can't prove that they're financially material or effective, which means that they can't prove that they have an impact on the profitability and financial performance of the company. Or they've passed altogether boycott laws that prevents some financial institutions to make business in their state if they are deemed to support too much sustainability. However, despite all of these rollbacks and these grim news and everything, we still see sustainability, sustainable finance policy developments. In particular, we saw these two rollbacks in the Asia-Pacific region, so in South Korea and in New Zealand. But these are the only ones, and one of them is just a postponement, and the other one is a proper rollback. But there are so many markets in that region, and they're all advancing their sustainable finance policy agendas. China is working on a big corporate sustainability reporting rule that would target public and private companies and small and medium enterprises. India is also passing a lot of climate risk disclosure and climate risk management rules through its central bank and its regulator. In Latin America, Brazil is really advanced. It's at the top of the G20 markets when it comes to sustainable finance policy, right up there with the EU and the UK. So I think it's going to be even more interesting to see how the political landscape in the different countries are going to act on the sustainable finance policy regimes everywhere. And it's going to be what we saw last year is that there is a lot of uncertainty coming up, in particular when it comes to markets where there's going to be elections, markets that have seen a recent election and could see some political changes. And it's not, we don't have a global movement anymore.
It's so interesting hearing this. And, at the start, I asked, where are we on this arc between going from sort of this being very much a thing being pushed by fringe groups, voluntary, and then ending up, the kind of the goal is for something to be singular and universal and accepted. And, where are we on that journey? And I know I said this a moment ago, but I'll say it again. But it seems like we're at this point where this stuff has become organized enough, meaningful enough for it to actually be in some ways a threat and for it to face pushback. And that's where we are. A phrase...
I never saw it this way. It's so interesting. You're so right. It's now it can have an impact and therefore it's worth, in certain cases, depending on your position, fighting against it because it actually has an impact.
And this doesn't, I'm not trying to say that, it's destiny that this is going to get to where it needs to get to being universally accepted.
Yeah.
But the journey to being universally accepted, this was always going to be a part of that journey. Some of my colleagues, I can't remember if it was Albert Chung or Colin McCarricker who first used this term at Bnef, or maybe they got it from someone else, but they've been using this phrase to describe where we are right now more broadly as the messy middle. That's where we are right now. We're in the messy middle. And this is the middlest mess I've seen it. It's very messy and it's very middle. It very much epitomizes that idea.
Yes. I sometimes think at Bnef we don't go the catastrophist vision, which is like, oh, everything is being rolled back, it's really bad, and everything is losing its ambition and everything, because it's not true. But we're also not going the full optimistic way, as in, don't worry, it's still gonna happen, there is no problem, we're gonna get through. But indeed, it feels like this messy middle. Sometimes, when we talk about adoption curve, it first spike really rapidly and then it drops a tiny bit. And I think we're in that drop for it to grow back again, maybe differently.
But it's still, if it is going to grow back again, this is part of the process.
Yeah. And I don't think that investors, for instance, and banks, aka lenders, who consume that data, the sustainability data, I don't think they're gonna let this being rolled back so easily. As soon as the weakening of these rules that I talked about has been passed by the European Parliament, some big industry group in the finance industry became quite vocal about the fact that they need standardized data and they need reporting from all types of companies.
This has been a really fascinating conversation, and I walk away with a renewed understanding, not necessarily of all the details, because it is a really complex area, but of the journey and where we are in terms of progression here. And so, yeah, thank you. It's been a really interesting conversation for me.
Thank you, Tom.
Today's episode of Switched On was produced by Cam Gray with production assistance from Kamala Schelling. Bloomberg NEF is a service provided by Bloomberg Finance LP and its affiliates. This recording does not constitute, nor should it be construed as investment advice, investment recommendations, or a recommendation as to an investment or other strategy. Bloomberg NEF should not be considered as information sufficient upon which to base an investment decision. Neither Bloomberg Finance LP nor any of its affiliates makes any representation or warranty as to the accuracy or completeness of the information contained in this recording, and any liability as a result of this recording is expressly disclaimed.